Hello and welcome to Young Turks, India's longest-running show on startups and entrepreneurship. I'm Shireen Bhan. Before I start, let me wish all our viewers a very happy new year. On all accounts, I'm sure the Indian startup ecosystem is hoping that 2023 turns out to be better than 2022. Fears of a recession, onset of a funding winter, piling up of losses and the agony of layoffs, it has been a difficult year. Venture capital investments slumped to $24 billion in 2022 from a record $35 billion in 2021, which we can all agree perhaps was an aberration, and we're now starting to see a little bit of a reality check. And therefore, one might say 2022 called for a reset on all metrics. The rout of newly listed tech companies has made investors demand a path to profitability as they rethink valuations. Unicorn after unicorn has continued to report staggering losses, from Byju's and BharatPe to Swiggy and Meesho. The list is long. It's quite evident that growth at any cost is now passé. In fact, the focus on conserving cash and bettering unit economics has forced some of the most funded, most valued startups to cut jobs. Indian startups have laid off over 18,000 employees in 2022. By most estimates, 2023 is going to continue to be a tough one for the global economy, and startups will not be immune to the headwinds. So what is the playbook to survive and thrive in 2023? Joining us on the show, Mohit Bhatnagar, Managing Director at Sequoia Capital India, and Prakash, partner at Accel. Gentlemen, appreciate you joining us, and a happy new year to both of you. Mohit, let me start by asking you that much talked about black swan note that came in from Sequoia in 2020 at the onset of the pandemic, and how different the world turned out to be, especially for tech and for startups. Record-breaking numbers. As we enter 2023, what is the note that you're sending out?
Well, first off, Shireen, Happy New Year to you and all your viewers, and thanks for having me back on the show. Look, a lot has changed, and still not a whole lot. And what I mean by that is we have to remember that investing and building companies and startups is a long-term approach. And there will be bear and bull cycles during that period. The overall sentiment really for us is after 5 years of unprecedented bull markets where any company was getting funded, we had a correction last year. And a lot of our startup ecosystem is well-funded, well-capitalized, but used the last 12 months to actually get fitter, to actually get more efficient, to actually cut out some of the extravagance, the wastage, and get back to the core that actually helped them create the startup in the first place. So it may not be as visible yet because all the latest numbers have not been put out to you. But I will say this to you. The vast majorities of startups in India have used the last 12 months very efficiently to hunker down, focus on what's core to their business, focus on just customers and product, and really cut out a lot of the extravagance. So I actually think they're pretty well poised because they're well funded and capitalized from previous years, and they're actually getting ready to be entering 2023 in a much fitter way.
So I would imagine, Mohit, that you're basing this on your experience with your own portfolio companies. So would it be fair to say that that the losses, and we just gave out some numbers for the likes of BharatPe, Swiggy, Meesho. BharatPe 5,584 crores, Swiggy 3,629 crores, Meesho 3,247, Udaan 3,000 crores. You're saying that because the environment has been difficult and people have been forced to hunker down and get fitter, we are going to see a considerable reduction in losses? Is that the experience that that you have based on conversations with your own portfolio companies?
There is a longer list of companies, including these, that you will see a definite improvement. And the unit economics has been a massive focus across all boards, across all founders, across all new investors in the last 3 quarters. And there are marked improvements in terms of the unit economics in many of these companies. So look, it's a journey for these founders. There was an expansive mode. Growth was getting rewarded. Clearly right now, quality of businesses is getting rewarded. And our founders are really sharp, really nimble, and will react to that. That's my expectation.
Well, they have no choice but to react to the current economic reality. Money is tight, funding is tight, and they will have no choice but to hunker down and get fitter to be able to survive and ride through this storm. But Prashanth, let me address this issue with you as well. As we heard there from Mohit, that he believes that some of these companies will perhaps emerge stronger through this down cycle. He also said that 2022 was a year of a correction. And to be fair, it's not just 5 years. We've actually seen a 10-year bull cycle for most parts of the world, the US included, and that really has found its way in terms of liquidity into large markets like ours. Do you foresee a long bear cycle? Are we in the midst of a long bear cycle? And what will be the casualties of this controlled growth environment that we now seem to have entered?
Shireen, thank you for having me on Young Turks again. I would say that there is another, dimension here, the whole IPO markets, right? And I think a lot of the reality check, while it came from investors, I think some of it also came from the ultimately the markets have to be where investors and these companies have to find profitable exits. And I think what was being rewarded there was very different. So I think the silver lining here is that if these companies are able to correct, like Mohit is saying, and I think a lot of them are on track to make these corrections and change their trajectories from growth and different types of metrics that were being rewarded to now what really the markets value. I think you will see that while there is a bear market overall in terms of funding, but they could still be great companies that find value in the markets and could IPO. And that could also create a better virtuous cycle and some positive momentum in the ecosystem. So that's the other thread that could really shape up this year.
Has the startup ecosystem understood, has that memo now really been understood about the divergence and the disconnect that we saw play through in terms of valuations with public and private markets? And have the lessons and the course correction been internalized? Prashanth, I'll start with you.
Yeah, I would say that it has been understood. These are two separate things, Shireen. One is the fact that you got to be profitable and that growth at any cost is not going to be rewarded by the market, I think is well understood. And I think there's enough corrections. Now, when it comes to discovery of what the right valuations are, I think, it's on company by company, based on the sector it is in and how the markets value certain brands. But there have been a good track record of other consumer companies, Shireen, 2 to 3 D2C companies that have gone public in the last year that are trading well above their IPO numbers. I don't talk about any specific ones, but there are a good host of them. So I think there is a good template, and the smart companies will apply that template and see what, they need to leave some money on the table for the retail investor. That's the bottom line. And SEBI and the other regulators are also now going to push companies to kind of adjust to this. So I would say all in all, there'll be an overall more readjusted environment for both valuations and for how companies would kind of go in terms of their IPOs.
Mohit, I want you to pick up on that as well. And overall, in terms of readjustment, to pick up on what we just heard there from Prashanth, are we done with the valuation readjustment to a large extent, or do you believe that there's likely to be much more pain on that front? And two, of course, the regulatory pushback is there. SEBI has made no bones about the fact that they're watching the startup DRHPs very, very closely, asking back for further information, making sure the disclosures are out there, much more effectively put out in the public domain. But on the IPO front, what's the expectation for 2023?
Actually, Shireen, I want to make 2 points. First is I think we should celebrate a big change that has happened in the last few years. Please understand, 3 years back, it was very unlikely for us to actually see a tech startup in India list in India. And then suddenly we had 2021, where he had a slew of companies, of founders who had made an important decision, which is that rather than sell their business to somebody else and be part of somebody else's house and consolidate, they wanted to build long-term, enduring, independent businesses. And going public was one way to do that. And when a founder makes a decision like that, it's a huge decision because now it is about being able and being answerable to many retail investors, to many other folks, to actually have not a
Yeah.
year-long AOP, but almost have a decade or two vision that they have to put out for folks to buy into their story. So I want to point out the fact that a lot of the startups that you're pointing out that have lost value are actually the forerunners and the pioneers for many other startup founders to learn as to how do you do this? How do you actually go public? How do you do a good public offering? How do you actually guide the street well? How do you actually make your business more predictable with better unit economics so that you can actually answer the street's call for profitability? But it's a positive thing, not a negative
Yeah.
thing, that Indian tech startups are
Sure.
choosing to go public in India. So that's point number one. Second point is please understand what's happened last year is happened globally. Some of the world's best companies,
Yeah.
tech companies, are down 60, 70%. So I don't know if we should be double clicking on these numbers and valuations as much as we are. These numbers could be vastly different a few months out, right? So for me, the bigger message here is having a long-term sustainable exit pipeline of Indian tech companies that understand profitable, sustainable businesses will succeed on Indian IPO markets, and us to make sure that we have a pipeline of those coming for the next decade. That's the important point.
Oh, absolutely. I completely agree with you. And, I want to reinforce the point that you made at the start that an IPO is not merely a financing event. It's much more than that. And I think, that is what both Prashanth and you are highlighting. But, this is the current reality. And to your point, Mohit, when you said that you believe a vast majority of, for instance, your portfolio companies will emerge stronger through this, where do you believe the vulnerabilities lie? Which are the pockets that will perhaps find it hard to make the pivot on the back of the existing business models? Because, it's going to be tougher if you're not, especially if you're not well capitalized and you don't have a long runway, tougher to get access to finance. And if you continue to burn as much as you are burning today, it's going to be hard to survive. Which pockets do you believe are going to find themselves most vulnerable?
So broadly, we've seen two types of businesses: those that are selling to, say, the developed markets like the US, or maybe to to Europe with the issues it's been having with the war. So think software businesses. We've certainly seen a softening of demand for companies that are in the exports or SaaS businesses. Frankly, a lot of businesses that have been going after the Indian opportunity in 2022 have actually hit plan, have actually hit their numbers. So far, we've seen that distinction between our companies. But I think the bigger point you're bringing out is the correct one, is if you were getting rewarded with multiple rounds of financing with vanity metrics like GMV and users, and that did not translate in a predictable manner into some level of monetization, then you're in trouble. And that just meant that you did not have real product market fit for actually having consumers willing to pay for your product or service. And those are the companies that I think would be the hardest hit.